I'm pleased this morning that we've been joined by Sheldon Macdonald of Architas, who's going to talk for the next few minutes on a number of things that are affecting their funds now their funds fit. So to start with, Sheldon, the last 6 months has been quite challenging. You're also in the process of your parent company selling the Architas range of funds. You basically want to give a brief outline as to how these things and how asset classes have affected your thoughts with clearly what's been going on in the last 6 months.
Sure, thanks very much, and thanks for giving me the opportunity to speak to you and to your clients. I guess let's touch on the Lion Trust acquisition first. So they, as you said, they're buying the Architas fund range, the UK fund range. The team of investment managers is moving across to Lion Trust. So myself and the rest of the team, we are moving across. The idea really is that clients will not really see much change. Yes, the fund names will change, but apart from that, everything that's happening under the bonnet will be unchanged. So in terms of processes and so on, the idea really is from Lion Trust side, if it ain't broke, don't fix it. You know, they've spent a decent amount of money buying the fund range. It's a successful fund range, a growing fund range. We've done pretty well in the UK market. Why disrupt a winning formula? Over time, yes, as always, as we would even with Architas, we will be looking for opportunities to improve. But as I said, at the moment, the mantra that we're putting out to clients is that everything is going to be as much as possible unchanged going forward. Now, touching then on in terms of process and what that means, how we look at the asset classes, that'll also be unchanged. So for the moment, it is bottom up. It will continue to be bottom up. We focus on harvesting the information that we are getting from the fund managers. So each of us in the team has a research and analyst hat on. When we have that hat on, we're speaking to the fund managers in our specific sectors. Each of us is a lead in a specific sector. In terms of doing the due diligence on the underlying funds, we're gathering information from those managers. That we have a process whereby that information then is shared with the rest of the team, and giving the opportunity for the team to debate and to discuss, to challenge the ideas and so on. But really, we're being led by that sector leader. That sector leader, as I say, on a monthly basis, is providing us with the insights that he's gathered, making his recommendations. We have a common framework that we use to look at the fundamentals in the sector. So that's the earnings of companies in that space and the valuations. We look at the macro environment, so global growth, unemployment, and so on. We look at the technicals in that space, so that's perhaps flows in or out, or we look at the sentiment indicators. And then finally, the analyst is using that framework to determine his overall recommendation in the sector, whether he believes we should be overweight or underweight or neutral in that space. As I say, that then gives the team the opportunity to discuss and to challenge, to debate those ideas. Generally, we will go with the analyst's recommendation. The analyst is, of course, the specialist in that space. He knows more than the rest of us around what's going on in that space. But we do have the opportunity to challenge and, in effect, to overrule the analyst in particular instances. So we do know that analysts are looking at their sector with blinkers on. They're looking at it on its own. When you take a more global view, looking at a sector versus other sectors, maybe there is a reason to potentially overrule the analyst. But as I say, that's relatively rare. Generally, we'll go with the analyst's recommendation.
Have you changed at all the way that you're evaluating different asset classes, say, from this time last year as a result of COVID?
Not really. I think we've designed the process to be relevant, to remain relevant across a market cycle. And we think that still holds. So we certainly like the bottom-up nature of what we're doing. We think that's important to harvest those views from the bottom up. Yes, we've had quite a remarkable cycle this time, and the speed of some of the changes, both down and then the recovery back up, have been quite phenomenal, really. But we think the framework that we have in place is still relevant. It remains, for us, the best way to evaluate and to analyze different sectors. So no, nothing's really changed fundamentally on that basis. Of course, some of the views have changed, and I guess we'll get into those in a few minutes. We're in a higher volatility regime now than we were previously, which means, I guess, we need to be a little bit more nimble, willing to change, to react to changing market dynamics and economic changes. But as I said, the framework itself remains unchanged.
Okay. The common press seem to have different theories, and on one of the things that keeps coming back with lots of clients in terms of when this recovery will come, what sort of shape this recovery will be. We get all these alphabet letters that now starting to appear: V-shaped recovery, W, U, and I've even had the client say to me they'd read that it was going to be an L-shaped sort of recovery, which effectively means that it's never going to recover. Do you have any particular views in terms of what you see as a recovery in timescales?
Sure. The one you've missed out there is the Nike swoosh shape recovery, a very long, drawn-out, slow recovery. Views differ. Clearly, the market has recovered pretty quickly. Is anticipating a strong economic recovery, and we have seen economies start to recover. We have seen a rebound in some of the numbers, the PMI numbers, which are based on surveys of managers on the ground. They're seeing things recover. So we're seeing some of those quicker measures, the sentiment-driven measures, recover quite quickly. On the other hand, there's some other elements that are still lagging behind. The initial recovery that we've seen, that seems to be elements that have been propped up by the stimulus measures that have been in place, and also to some extent by the easing of lockdowns. The government has essentially given a blank check to the economy, saying, they'll do whatever it takes. The question for us, though, is how long can they continue to support things? Some of the initial measures that they put in place, some of the support measures, are beginning now to roll off. So the question is, will governments actually step in again to refresh those elements? Or if they let them roll off, if they expire, what does that mean for economies? So there's a lot of questions out there. There's also the question of how do we pay for all this? So just in the press here in the UK in the last couple of days, we've had the question marks around whether Chancellor Sunak is going to be increasing taxes anytime soon. The word is no, but at some point we do have to pay the bill, whether it's through increased taxes or through austerity. Unclear yet, but maybe now is not the time for taxes to be raised, but when? So still lots of questions out there. So I think the recovery will be slower than the market has anticipated. On top of that, everything we've spoken about around the pandemic, there's all the other risks that are still out there as well. So what does the US election mean for the global economy? What are, the US-China trade spat seems to be flaring up again at the moment. What does that mean? We got Brexit. What is that going to mean specifically for the UK economy? So a lot of questions out there, a lot of kind of known unknowns. We know these questions are there, but we don't know what the answers are. And then, of course, there's the unknown unknowns. So, political and military posturing in Southeast Asia. What is, could that flare up into a shooting war? Who knows? And if so, what does that mean for economies? Regime change in North Korea. Unknown unknowns, things that we just can't model. We can't get our heads around them until they actually happen and we see the results. So for me personally, there's a lot to be worried about, a lot to be cautious about. On the other hand, we are seeing economies recover. Governments do seem to be learning how to live with COVID. it looks like full lockdown is probably not the way to go going forward. So if there is a resurgence in the pandemic, maybe we can massage the economy, as I say, learn to work around it to keep the economy going despite rising infection rates. So there's reasons to be positive. On the other hand, also, as I say, reasons to be cautious.
So what message do you say to our clients, where we both know that trying to time the market is extremely difficult, and in a lot of cases foolhardy, as to why they should be currently invested as opposed to waiting for things to settle down with the uncertainties that exist, and in particular, I suppose the UK, which hasn't performed as well as its counterparties with such things as the likes of Brexit, as to why it's important that perhaps a client should be still fully invested.
Of course, this is the perennial question. Our constant advice is, look, stay the course. You're invested for the long term, on a long-term basis. You've worked with your advisor and your client together. You've determined the correct risk level to be in. You're in a multi-asset portfolio or solution, which is giving you exposures to multiple sectors, multiple asset classes. You've got the diversification that is suitable for you. As you said, trying to time the market is often foolhardy. I mentioned my own cautious stance. I've been cautious, for the last 3 or 4 or 5 years. And if you'd not been invested for the last 3 or 4 or 5 years, you've missed out on, effectively what's been the longest bull market in history. Yes, that came to a sudden end, and there's been a bit of volatility that clients have had to withstand. But I think equally the recovery has shown just how quickly things can change. And if you are trying to time the market, getting in, getting out, it is particularly difficult. Things can change pretty quickly. I mentioned earlier, we're probably going to be in a higher volatility regime going forward. And I think that makes it even more important for clients really to take the long-term view and to maintain the courage of the convictions, believe in the risk profiling that has been done, and believe that you're in a solution that is taking into account your particular capacity for taking on risk and your ability to take on risk.
Are there any in-house views in terms of where you see real opportunities in the next 12 to 18 months, as opposed to areas where you are wanting to avoid? I suppose one area that has only a small exposure would be commercial property, and quite often clients think as commercial property as just being those that exist on the high street, for example.
Mm-hmm. So quite boringly at the moment, across the equity space, our view is neutral. As I say, it's quite boring, but really we see this balance of opportunities and risks that are out there. So, I've spoken about many of the risks already a second ago. Valuations in the equity space are better than they were before, so we're maybe slightly less concerned than before on valuations. But on the other hand, those valuations are predicated on expectations for an earnings rebound. Now, personally, I don't think we really know what the future is going to look like for a lot of companies. We've had this disruptive event. Are we going to go back to the same ways of shopping that we had before, of entertainment? Are we still going to go to the movies? Are we still going to fly? Are we going to go on holiday? So all these questions I think can't yet be answered. So there's for me some concerns around the earnings. But on the other hand, as I said earlier, we've got government support. This blank check in terms of quantitative easing. Governments are underwriting the debt of companies, so companies less likely to go to the wall going forward. We've got low rates, and essentially governments have promised those low rates for the foreseeable future. Positive effects from that. So we're seeing, house prices are at record highs. Turnover in housing is a positive, because when you buy a house, generally, you go and buy a new sofa, you go and buy a new washing machine. So you get this positive boost from things like that. So there, as I said before, there's reasons to be positive. Against that, though, there's also risks out there. So that leaves us overall cautious. Where we do think maybe we can take a little bit extra risk, where we are slightly overweight, is in emerging market debt and in high yield, fixed income high yield, where, yes, there's risks, but a lot of those risks being underwritten by governments, as I mentioned, and the extra carry, the higher yield that you get, kind of pays you while you wait. So you're getting that yield, that income coming through on a regular basis. We think the risks there are skewed to the upside. You mentioned property, which is an interesting one at the moment. Obviously, we're all dealing with property funds that are gated. They've all gated. That means you can't take your money in or out. They've done that because they speak about this uncertainty of the valuations. Now that's, again, part and parcel of what's going on. A valuer going to put to try and determine the value of an out-of-town shopping centre. How does he know when or where shopping patterns are going to return to normal? We just don't know. As I said, we don't know if we're going to return to the old way of doing it. Are we all going to buy everything online going forward? Who knows? It does seem clear that there are some opportunities in that space. So, as you mentioned, there's specific ways of playing property. So, we've across different portfolios in our range, we've got things like something called Tritax Big Box. And this is these massive distribution warehouses that you see on the side of the motorway. Clearly, regardless of of how things might change as we come out of the pandemic, it does seem clear that going forward, we're going to be doing much more shopping online. That means logistics solutions are going to become more and more important to the networks that we have. We've got other exposures to other specialist property areas. So social housing remains an ever-present issue that needs to be dealt with. We've got exposures to doctor surgeries. We're playing some funds that invest in property debt as opposed to the equity. So always looking for diversification that we can find, looking for ways that we can take advantage of some of the dynamics that are playing out at the moment. Exposure to property overall, though, remains fairly low. It is a risky area. It is an area where the risks are different to those elsewhere. You're worried less about the volatility of the property's price. You're worried more about the liquidity of that property, as we've seen with some of the gatings. So we again are keeping a cautious stance on property. In our risk profile portfolios, exposure to property is somewhere below 5%, generally across the board. And within that, as I say, looking for these opportunities to find diversification, to find some different drivers, some different dynamics within the space. And that really is what we're trying to do across the portfolios, is find that diversification, use the diversification to try and control the risks in the portfolios.
Would you like to just expand a little bit, Sheldon, on why you see active funds playing a large part in your portfolios, as opposed to just having cheap and cheerful passive funds, for example, which the constant question we get asked from clients in terms of, well, can't I just replicate what a particular index is doing and get my exposure that way?
Sure. So in our blended range, we are actively targeting and moving dynamically the weighting of active versus passive in the portfolios. We look for those areas where you can get greater opportunity, greater likelihood, and a greater scale of outperformance for the level of fees that you're paying. So, for instance, at the moment in the US and UK, all of our exposure in the blended range is via active funds. We've moved that quite recently. We used to have about half the exposure from passives. We've moved to actives on a dynamic basis because we think going forward there's the opportunities. Now, you and some of the people watching may have heard in recent weeks, there's been quite a bit of discussion around this, especially in the US market, where you've got 5 stocks that make up more than 20% of the S&P 500. So 1% of the number of stocks making up 20% or over 20% of the value of the index. And that's the FANG stocks. They've recently been expanded. They call them the FAN MAG stocks now. So you've got Facebook, Amazon, Netflix, Google, Microsoft, Apple. These have really been doing really well. Obviously, they've been driven upwards by what's going on at the moment. They're in the right place at the right time. The move to online, the move to doing things virtually has really supported these stocks. They were already index heavyweights. As the index rises overall, as they rise, and as we've had this massive flow of money into passive solutions, those passive funds have had to buy these stocks, disproportionately to all the others. So you've had this kind of virtuous cycle taking place. Money flows into passive funds. They buy, according to the market cap, these are the big heavyweights. So they buy more of these big heavyweights. These big heavyweights happen to be doing quite well at the moment. So active players are buying them as well, pushes them to even bigger weights, draws more money into the passives, and so on and so on. Now that's been a difficult environment for active managers to outperform in. In an active portfolio, you're probably not going to have those levels of concentration in those stocks. So you effectively, active managers have been underweight those particular stocks. So that's created a headwind for them. The point for us, though, is that going forward, we think that creates an opportunity for active managers. Just think of an environment where that starts reversing for whatever reason. If we get to a situation either way, money starts flowing out of the passives, or money flows out of the sector, or these stocks, the market maybe decides that these stocks have been pushed to prices or to valuations not justified by the fundamentals, and they start underperforming. That's when active managers come into their own, because at that point, they've got the diversification into other stocks that aren't going to be pulled down with these big heavyweights. So we think there's this opportunity for active managers right at the moment, and so we do still hold faith with active managers, and as I say, in particular in the UK and US, which are sort of traditionally areas where active managers do struggle, where it's been difficult for them. They're very efficient markets, areas where there's no real advantage to doing the underlying research because everyone else is doing all that research as well. So, as I say, at the moment, increasing exposures there because we think there is the opportunity.
What do you say to the client who thinks that the investment industry should have been thinking about the impact of what was going to come on with COVID before we were hit with the sell-off and caught everybody by surprise in February and March of this year?
Yeah, I think that's a fair criticism. I mean, we as investors are paid, I guess, to try and discern what's going to happen going forward. Having said that, there's going to be times when, as an industry, we get it wrong. It's happened before; it will happen again, where we're caught offside really by the speed and the scale of what happened. Especially when you're dealing with matters where government policy starts to take over. That's when things can change very quickly, as we've seen. So what moved from being a local problem in China, and yes, we were looking over our shoulder and wondering what was going on, and we all started washing our hands a little bit more. All of a sudden, you've got governments stepping in and closing borders, cancelling flights, introducing quarantines, lockdowns, and so on. I think that level of government intervention was just completely unforeseen. The challenge is, or the challenge to us is, was it unforeseeable? Maybe we should have as an industry, been looking for what could happen, what is the worst case outcome in some cases. In the last couple of months, the one word that keeps cropping up is unprecedented. We've been in unprecedented times. We've not seen these things before. So on that basis, maybe as a bit of an excuse as an industry, we can say, well, look, we just didn't realize that this level of government intervention was possible. Certainly going forward, I think we'll be certainly more aware of the scale to which that might happen. But I think yes, it is probably a fair criticism to say yes, we as an industry might have foreseen things a bit better. On the other hand, as I said, unprecedented. We never had any sense of the scale of intervention that we've had this time around.
Your fundamentals in terms of proportioning things to different asset classes, has that changed in any way, or is it too early to tell with what happened in the last months that might influence how you evaluate asset classes perhaps in a different way?
Sure. So the main driver of our asset allocation in the risk profile portfolios that we manage comes from eValue. So eValue is an independent risk provider. It's a quantitative model that is using historical data as well as forward-looking forecasts to build on a quantitative basis, the most efficient portfolio. So it's building your portfolio that is expected to deliver the highest level of return at a given level of risk. So that's our starting point for managing the portfolios. Now that model, as I said, that's using 15 years worth of data, and it's looking 15 years forward. And while it is reacting to changing market dynamics, because you're getting new data into the model, it's seeing volatilities rise, it's seeing correlations rise, it's seeing valuations change. So yes, it is reacting. On the other hand, it is 15 years, so the changes tend to be fairly slow and fairly gradual. We've just had an update on the model at the moment. We put it through at the beginning of this week. The model is starting to see less value in, for instance, in corporate bonds. UK corporate bonds is saying, look, these are overvalued. Let's reduce exposure in that space. So it's taken that exposure down. It's increased exposure, though, to balance that into UK gilts and to global government bonds. Now, you might say those are equally overvalued. Discuss. At least, though, although those asset classes, the government bonds might be overvalued, at least you get from them lower volatility than you get in corporate bonds. There's less risk attached to those. So the model is trying to, it is reacting to the changing dynamics that we've seen. That's quite normal. It's we've not changed the framework at all. Apart from what we get from the model, we're overlaying our tactical views, introducing overweights and underweights where we see that we can either reduce risk or potentially add some value on the upside. As I said, at the moment we're pretty neutral across the board, except for those overweights that I mentioned, which are in high yield bonds and to a slightly lesser extent in emerging market debt.
Okay. One final question, which is somewhat related to investments, but clients ask the question in terms of how much emphasis are the markets placing on a vaccine. If a vaccine comes pretty quickly, does that mean markets will take off? If a vaccine doesn't come, are we going to test the lows of maybe what we experienced several months ago?
Tough one. It's obviously always impossible to know exactly what markets have priced in or haven't priced in. And of course, you've got this weird dynamic at the moment that bad news has been good news. So when things are going wrong, we get more government stimulus, and that pushes markets up. So you might get the reverse happening. governments see there's scope for a vaccine, maybe they can withdraw some of the support that they've been providing, so that might offset the positive benefits. All in all, I think, yes, if we do get a vaccine and it does work, there will be a relief rally of sorts. Obviously, we've already risen quite far. There's an old adage in the market that says, it's better to travel than to arrive. Stated otherwise, it's buy the rumor, sell the fact. So maybe markets have already anticipated the potential for a vaccine, and maybe on the announcement of the vaccine, you get people taking profits. So I'm offering kind of different views there. All of that really goes to say that it's just impossible to know precisely how the market might react. I think, yes, on balance, we'd probably get some kind of a relatively muted relief rally. I think people will want to wait and see the efficacy of any vaccine, because of the speed that everything is happening. It's hard to, the trials will be rushed through. We won't really get a picture of whether it's working. We've also got this situation of, is the vaccine, is the virus mutating? Will the vaccine work in that, for different mutations of the virus? So there's still a lot of unknowns there. Generally, though, as I said, I think it will be good news if we get some news on that front.
So timing the market is now impossible.
Yep. As we said before, it's difficult at best, foolhardy at times. Yes, we do try and introduce tactical tilts to try and take advantage where we can. But outright timing the market, as you say, that's pretty difficult to do.
Okay. Well, Sheldon, as always, your views are valuable. Thank you for taking part in this discussion, and hopefully we'll follow this up in a couple of months' time with see again what's been happening, and maybe the outlook will be a little bit more positive rather than uncertain. But thank you for taking part. Really appreciate it.
Thanks very much. Yeah, let's hope the outcome does, or the outlook does settle a bit. But in the meantime, thanks for the opportunity, and hope to speak to you again soon.